Hi, and welcome back to the Auction Market Theory 102. We're going to discuss now trading ranges in failed auctions. So whenever price approaches the extremes of our fair valuation area, where statistically 70%, which is a standard deviation, of volume is traded, of money is exchanged, of trading activity is happening, we get into the anomalies. Okay? The same principle we've decided and decoded before. These are the areas where we either want to sell at as soon as price approaches them, when we see confirmation from order flow, or wait to be broken and see an attempt of an upside auction failing, which is even better. Okay. Same thing over here. When this happens, or when this happens, those are potential high probability buying opportunities. So we want to then take a look at what happens with order flow inside of these areas to find a confirmation that passive and aggressive forces are giving us a asymmetric opportunity from a risk to reward and win rate standpoint. So we want a high probability of going up and a high risk to reward for taking that trade. So these are very simple models, very simple models. We take a daily volume profile and we look at what happens here, what happens here. We wait for a confirmation that price will drop back inside, and we take that trade to the other side, and vice versa. Now let's make an example, a practical example, by looking at a situation of clear fair value and looking at what happens in the following session. Well, we know these are the areas, so let's remove the volume profile so we can just see the price action and the order flow. The next session starts here. So we already have a good indication. We started our session inside of the previous value area. Then what happens? Take a look at order flow and we read what might have happened. Well, the first idea, as we said, is we're going to try and see if there's any buy opportunity here, right? So we see price dropping, dropping, dropping. And at some point here, we see a lot of volume traded from both sides. So we have a war here between buyers and sellers, which we could consider some form of absorption. And when we try to auction lower, what happens? There's a dry up in volume. There's some selling, but buyers are way more aggressive. Well, that's a failed auction right here. We have a big phase of absorption. So price did something like this, tried to push out, then was dropped back inside by aggressive buyers. So we have a failed auction. And then price pushing high really aggressively. A lot of imbalances on the side. That's when we know where we have, let's say, the first indication that price is likely to bounce back off. Can take volume itself. So there was a lot of volume in this candle, but no follow through. And the following candle dropped back inside. And from here, this is our buy idea to the other side of the range. You could either wait for a test or wait for the following candle to close, and even maybe take a slightly lower risk to reward, 1 to 2, and that's a high probability trade. Now let's go to the other side and see what happens. Well, we have buyers really aggressive on the upside. As soon as we're outside, big volume dropping back inside. But the candle still does not close back inside. More aggressive buying is being absorbed here. And as we stay outside of here, volume dries up. So there's a phase of exhaustion. There's not a lot of trading activity here. And then what happens? Well, we drop aggressively back inside with even more volume and a lot of aggression, a lot of imbalances. Well, that's the first indication that we might continue lower. So we either wait for a test here, or for example do this and sell. In this one we likely get stopped out. But we took a good decision. We took a smart decision. The point here is not, making money all the time. The point here is looking at what's happening in the auction and acting accordingly. And then once again, what happens? We tried to drop back inside. We saw there was a lot of aggressive selling going on, but maybe they were not ready yet. So buyers take the upper hand again while being inside of the range. They push price outside, and as they do, volume again dries up. Aggressive selling, pump in volume. And the last candle that tells us buyers are not ready is here, where we see again an exhaustion in buyers that tries to push up very quickly. They go down, and the following candle is just unrefutable proof that we're ready to drop back inside. Look at this. Super high delta imbalances, super high volume, drops back inside, tests, and that's our entry. And slowly but surely, that's what happens. So with this very simple framework, we took one trade, take profit. We took another trade, stop loss, and took the last trade, take profit. With a very easy framework, looking at what buyers are doing, look at what sellers are doing, framing the auction correctly, so we have a context of what we want to do. And we take the decision based on data. We take the decision based on what the money is telling us.